At this point, I am very pleased to present our first presenters, Kirk Hovde and Curtis Carpenter of the Hovde Group. They are teaming to give us insight into what's next for community banking. Kirk Hovde is managing principal and head of investment banking at Hovde Financial in Chicago. He is responsible for leading the firm's investment banking practice, as well as evaluating the financial and strategic options of financial institutions. Kirk performs financial analysis and valuations of banks and thrifts, assists in facilitation of M&A transactions and capital offerings, and assesses the impact of national and regional trends on the financial services industry. Curtis Carpenter is Senior Managing Director in the Investment Banking Division at Hovde Financial. Curtis covers regional and community banks in the Texas marketplace, as well as other select markets around the country. Curtis has a long track record in the community bank space, working for many years at Sheshanoff and Company. He also worked as Executive Director of the CEO Affiliation Network. Curtis has been involved in almost 100 successful merger transactions representing both buyers and sellers. You will find printouts of the slides at your tables if you would like to follow along with your own documents, or as I said, you can access that QR code in your folders and follow along online if you choose. Many of you know Kirk and Curtis as they have presented at our events before. So let's give them a warm welcome this morning. Here's Kirk Hovde and Curtis Carpenter.
Thank you, Tom.
Thank you, everyone, for being here this morning. I think I can speak for most of us that it's nice to finally be back in front of so many people. The last 18 months have been very unique and have caused a lot of turmoil for people being stuck at home, and so excited to be here presenting to everyone. As Tom said, Hovde Group, we've been around for 35 years. It was my father, my grandpa, and my uncle founded it. We have focused on community banks and other financial institutions for that entire time, and we had the pleasure since the last in-person of welcoming Curtis Carpenter to our team last year. And with that, I'm going to turn it over to Curtis.
So Kirk and I are going to be sharing the presentation with you today, and we're so glad to have a collection of bankers to talk about all that's happening in the industry, because there is a lot going on. The Hovde Group has a peer group with about 200 banks throughout the country, and we interviewed the CEOs of those organizations, asking them, what is it that keeps you up at night? And we got just a flood of concerns, and here they are kind of ranked by intensity. The compressing net interest margin is on everyone's mind. Aging board and staff is kind of a recurring issue. Fintech, cyber, regulatory stuff is kind of on the rise and concerns. Crypto. I mean, there's just so much on your mind as a CEO. But on the positive side, it's a pretty short list. I mean, maybe rates are going to go up sometime. I mean, maybe loan demand is going to finally kick off again. But the main source of optimism for bankers is this mysterious, nebulous thing of just community bank resiliency. Many of you are baby boomers like I am, and have actually been through the S&L crisis, the oil and gas crisis, the real estate crisis, the financial crisis. Now we've gone through a pandemic, and community banks always seem to just kind of rise from the ashes, the work ethic, the quality of community banks. So we're counting on that happening again, but let's talk about what's going on.
Yeah, so what we want to cover today is a broad base of topics. We're going to cover macro industry trends, what we're seeing in the macro environment, how that then boils down into community banking on earnings and the headwinds that banks face today. You know, I think 2020 and 2021 were surprisingly good years for you as bankers, even though you had a lot of turmoil with having to figure out how to work remote, shut down your branches. Your numbers speak a totally different thing than what we saw in the economy. Banks were having some of their best years in 2020, 2021. A lot of that, though, if you look back, you had elevated mortgage with refi and purchase activity. You had PPP. Who knows? We're talking about another $5 trillion of potential spending. Maybe there will be some more PPP. I don't think you can bank on it, though. And so the headwinds you face as an industry now on NIM, taxes, and potentially asset quality. And then from there, how do those headwinds impact the bank stock market and M&A? And then if you are considering a merger or a sale, what the process behind that is, and then where, to finish it off, where we see a vision of the future.
So let's talk about some of the macro industry trends. First of all, the industry is consolidating. Here's a map of all of the financial institutions that exist as we sit here today by state. So in blue are states that have over 200 banks remaining. You can see Minnesota and Iowa are kind of right up there among the top. In red are between 100 and 200 banks remaining, and in gold, states that have fewer than 100 banks remaining. So in large areas of the geography of the U.S., the M&A game is already over. Banks in those states simply cannot look at acquiring as a way of growing any longer. So you can see where the M&A activity is going to be occurring, but we can also take a look at where it's heading. If you look at the pace of consolidation, with the recent trends, about 1 in every 10 banks will sell every 24 months. It's a 5% consolidation per year. So if we look forward, where is the industry going to be in just 10 years? It's a map that looks something like this. So you can see just how critically important the strategic decisions are that your board is making this year relative to where the industry is going to be in the next 2, 3, 4, or 5 years from now. So let's talk about the macro trends. Consolidation, as we said, is completely transforming the industry. As Kirk said, profitability in 2021 was buoyed by 3 transitory items: negative loan loss provisions, PPP income, and the end of the mortgage refi boom. And banks are seeking earnings growth through acquisitions and through MOEs. Fintech is becoming a major topic in boardrooms around the country. And as one young banker said, I'm kind of stealing his line, his basis for optimism is, he said, most bankers are opportunity averse. I thought that was an interesting line. Bankers just tend to be so conservative and steady as she goes. There's a lot of opportunities out there, and many of your competitors are just not going to be taking advantage of them. And so let's talk about the macroeconomic environment. You've noticed that the U.S. has just lost its fiscal discipline. We're at $30 trillion now in debt. It looks like we're going to go to over $40 trillion in just about 10 years. The deficit spending is rampant. And when you look at the U.S., except for Japan, we're kind of leading the world in terms of stimulus spending as a result of this pandemic. And that leaves us with a yield curve environment that looks something like this. These are the 3 major curves that affect bankers. In gray, Fed funds rate, now near 0. In red is the 5-year, and in blue is the 30-year. And you can see that rates started to kind of trip up a little bit in the spring, and they've come back down. And it's a very difficult environment to run a net interest margin in. Here are the 3 yield curves. The bottom curve is where we were just 1 year ago. In red is where we are now, and the top line is where we were 2 years ago. And you can see the big difference here is in about the 5-year down to the current time period. There's just no margin in there, which is creating tremendous net interest margin stress on banks. So let's talk about the major headwinds facing banks as we kind of turn the corner from the pandemic. The first one is taxes. You might recall that it was the Trump tax cuts that finally boosted bank ROAs out of the mid-80s into over 1% in 2018 and 2019. In fact, so far this year, with the negative loan loss provisions and some other factors we talked about, bank earnings are actually creeping as high as they were at the peak back in the 1990s. But all of that is threatened by a potential increase in the corporate tax rate, which more than likely is going to come at some point. When you look at efficiency, as a result of all of the liquidity and kind of stimulus spending, efficiency has reached almost its peak in the industry that was matched back in the 1990s. So banks are kind of at full tilt from an earnings standpoint, and asset quality is something that has been on the minds of bankers throughout the pandemic and is a key factor as we look forward. Year to date, the industry has taken about a negative 5 basis point negative loan loss provision. Obviously, that can't continue into the future. And as banks begin making loan loss provisions, earnings are going to suffer from that. But when you look at asset quality, you can see why that's occurring. Non-performing assets are as low as they have been in recent memory. And when you look at the acid test, it is the credit mark that buyers place on acquired portfolios. So these are all the deals that have been announced for the past couple of years. And we've got in here the credit mark that publicly traded buyers publicly announced they were making on the target acquisition. That red line is at 2% credit mark. And you'll notice that most of the recent transactions have been below that level, recently a couple above it. But in these highly scrutinized transactions, where buyers are taking a very conservative approach toward asset quality, they're only coming up with about a 2% mark, which is about where we were before the pandemic. So at this point in M&A pricing, asset quality is not a headwind on M&A pricing. But something that's completely different is net interest margins. If you look here, you can see that margins were trending downward before the pandemic, but they've really been impacted by the zero interest rate environment. And this is what has bank stock analysts so concerned, and that's why bank stock prices have been so muted throughout the past couple of quarters. Here's a look at the trend in net interest margins for the past 7 quarters for the industry, but we have the industry broken down into loan to deposit ratios. So on the far right-hand side, you've got banks that have over a 90% loan to deposit ratio. On the far left-hand side, banks that have less than a 50%. So on the right-hand side, banks that have access to lending, organic loan growth that are in markets that produce those have been able to limit the damage to their net interest margins. On the far left-hand side, you can see a far different story. And this plays out in the world of M&A. If you are a bank that is in an area that has organic loan growth, there's a long list of banks that want to buy your institution, and the pricing is strong. Kirk has represented several banks in markets like that. Over on the far left-hand side, banks that have a lot of liquidity, loan-to-deposit ratios, 50, 60%, it is hard to find anyone who wants to buy a bank in those markets, and the pricing reflects that. We'll talk more about that in a few moments. When you look at the trend in net interest margin, you can just see why that is. In gold are banks that have over an 80% loan-to-deposit ratio. In the middle line there is 60 to 80, and the bottom line in blue is less than 60% loan-to-deposit ratio. There's a 72 basis point difference in net interest margin for banks that have access to a lot of loan growth and those that don't. And when you look at where the margin is now and where it's going, you can see why the publicly traded bank stock market is just so depressed. So far, both loan yields and deposit costs have mirrored each other on the way down. On the left axis is loan yields, on the right axis is deposit yields or deposit costs. They're both down about 80%. But deposits are now at 28 basis point industry-wide. Loan yields are at 423. And you got to figure loans have a lot more way to fall than do deposits, so more compression is coming. A quick primer on PPP accounting. Although PPP loans only earned a 1% rate, they effectively had a 4% yield because the fees on those loans were amortized over the life of those PPP loans. Most bankers we talk to feel like in the first quarter of next year, all of the PPP loans will have exited their balance sheet, leaving both a void of loans and a void of a 4% yield asset. So you can see why more net interest margin compression is likely to occur. Here is a look at the cost of funds by size of bank, again over the past 7 quarters. The big story here is that the biggest banks in the industry, $10 billion and larger, have driven their cost of funds down to just 16 basis points, whereas the smallest banks in the country are in the mid-30s. That's exactly the opposite of where we were, say, 10 years ago, when it was kind of a given that the big advantage that community bankers had was their relationship with their depositors, and they just didn't have to pay up as much for their deposits. Well, that is now reversed, and it's putting a big strain on community banks. So now let's talk about how all of this is impacting bank stock values and M&A.
So to follow on Curtis and some of the comments he made, I had one quote from a banker in December of this past year, and he said, "Kirk, if I would have told you back in April or May of 2020 that I was going to complain when PPP started rolling off my books, I would have told you to shoot me." And he's like, "Now I don't know what to do because we're starting to lose that. We don't have any new loan growth to replace it. And we have all this excess liquidity that we just have sitting in overnight funding and nowhere else to put it. So what do we do?" And as you think about it as bankers, quality loans are hyper competitive to go for. Whether you're caving on yield, you're caving on covenants, whatever the terms may be, you've got banks, you've got credit unions, you've got non-banks, you've got fintech companies. Everyone's trying to find yield somewhere, and so that's where we see the biggest pressure on NIM, is not only are there fewer good loans because of all the liquidity out there and people being hesitant to borrow, but the competition amongst your peers and external parties is immense. And so what you see in the impact of bank stocks and how it's translated into M&A, this first graph is going to show you from December 31st of 2019 how bank stocks have fared compared to the S&P 500. You'll see right at the beginning that big fall off, that was COVID, and you'll see that bank stocks are only up 7% since then. If you look at the S&P 500, you'll see that in about August of last year, it had fully recovered and surpassed where it was to start the year. So it took all of 8 months for the broader market to forget about COVID and say, we're good, and it was led primarily by tech. If you look at bank stocks, you'll see we kind of hovered for a while until early November. The big things that happened then, you had the election behind us. There was obviously a lot of uncertainty on who was going to be elected. That dragged out for a while. But the biggest thing you had was that's when you started to get COVID vaccines being announced that they were going to be available to the public. So you saw the bank stocks actually perform better over that period up and through until end of May than the S&P. But since then, we've now seen bank stocks trade flat, little lower, and it's being driven by the concerns on the earnings front, regulatory front, uncertainty around taxes, and there's a bunch of unknowns. We're still sitting out here with the House and Senate bickering about the $3.5 trillion bill, the bipartisan infrastructure bill, what's going to happen to taxes, if anything at all. This was an interesting slide as well that we looked at. If you looked at the correlation of bank stocks to the 10-year Treasury, you'll see that in 2019, they were negatively correlated, so meaning they were moving in opposite ends. But 0 means zero correlation. -1 would be perfect correlation the opposite way. So it was actually closer to being essentially not correlated than it was to correlated. However, in 2020 and 2021, you've seen that they've moved essentially in lockstep. Every day you see rates tick up, you see bank stocks move 3-4%, especially the ones that are more asset sensitive. So what we're seeing here is the bank stocks following the 10-year, and it's looking like it's going to continue. Here we give a brief look. We just looked at Midwest regional banks sorted by price to tangible book value. We narrowed this by banks with less than $100 billion in assets to take out the really big banks, and then only showed banks trading above 125% of price to tangible book. So there's obviously more banks to this list that are trading below 125, but just want to show this little subset. And you'll see that the median price to tangible book is in that mid-160s. But on the earnings side, you're only sitting in the 11 to 12 times forward earnings. And a lot of that is the fear on the street by the analysts and the institutional investors that banks' earnings aren't going to grow at the pace that they had. And they're also carving out a lot of that one-time earnings of PPP and mortgage-driven business. What's that mean for M&A? When you look at the select S&P 500 sectors here in the forward PE ratio, you'll see that bank stocks are trading at the lowest PE multiple of any other sector. And they're going to continue to trade in that realm because of the uncertainty around the earnings and the lack of growth. You know, if you look at tech companies and the valuations they get, any bank would love it. And if you take a Silvergate out in California that's basically dropped the name bank and they just focus on Silvergate and they deal with crypto, they trade at significantly higher levels. They're trading like a tech company. They have, at one point, they had 1,000 price to tangible book ratio and 40 times earnings ratio. So they're moving more into the fintech side of things because they see more growth and profitability there. This looks at all the publicly traded banks out there. We looked at pre-Trump, the peak, which was actually in August of 18, December 31st of 19, and then where we are currently, and we put it into 7 different buckets. You've got less than tangible book to 150, 150 to 175, 175 to 2 times, 2 to 2.5, 2.5 to 3, and over 3 times. And what you'll see currently is that 64% of the banks are currently trading below 150 of tangible book. If you go back to the peak in that second group, you had 59% of the banks, so 41% of the banks were trading below 150, with 59% trading over 150. And you'll see in the above 2 times, we only have 40 banks currently trading above that. While a public buyer isn't necessarily the buyer for every institution, the private buyers do watch what the public guys can pay, because if they are the competition and there are the deals that usually have pricing terms disclosed, if you see public buyers paying a lower price, you as a private buyer are likewise going to say, hey, if their deal's going off at 130, 40, 150 of tangible book, why would we pay 180 to 2 times if those deals aren't happening out there on a larger scale? So the pricing of publicly traded bank stocks flows through to what you see in the M&A space. Again, here, this just looks and says more banks with strong currencies are needed to bring back M&A pricing. Our pricing, which we'll see in a little bit, has gotten back up to 2019 levels on average, but that's still below the 2018 peak. And the question is, where's it going to go from here? Bank capitalization. Banks are extremely well capitalized right now. You can see it's better than it's ever been in history. You've got banks that have built equity through retained earnings and strong earnings over the past couple of years. You've had banks less on the common equity side. You've had some banks going out and doing preferred equity with the terms. Subordinated debt has become the big instrument of choice for a lot of banks. However, you look at where Apple's market cap is, and it's bigger than the entire banking industry. So as you think about where banks are going compared to where tech companies are going, just keep that in mind. The types of M&A deals that are starting to happen. What we looked at here is pre-pandemic versus post-pandemic. MOEs are always talked about at every conference. It's something that people like to speculate about. They're kind of the sexy deal out there. They made up 7% of deals pre-pandemic. They've made up 9%. So they're starting to gain some more steam. Investor groups made up 10%. Now they're making up 12%. And then traditionals down that extra 4% to 79%. And what we call an MOE, to me personally, there's never two equals. One party's more equal than the other. You're either going to see it in ownership, board, makeup, management. But we look at it and say 60% or greater of a buyer's assets were acquired or merged with the seller. One of the reasons you're starting to see an uptick in some of these deals is you'll see that the median price to tangible book value paid on an MOE, on an investor group, and traditional, pre-pandemic, investor groups only paid 134.5% of tangible book, whereas MOEs and traditional were right in line, 158 to 156.5. Now, the MOEs and investor groups are actually paying higher multiples than your traditional M&A deals. I actually worked with a wealthy family that made their money in fintech. Guy was probably in his mid-30s, I think worth close to $1 billion, and they wanted to buy a one-branch bank out in California, and they paid $160 of tangible book for it, all cash, did a tender offer. And their plan is actually to transition it to be a bank more focused on fintech companies. So not an actual fintech company, but a bank servicing fintech companies and looking at what a lot of people would say is the antiquated offerings that Fiserv, Jack Henry, FIS have out there, and how you kind of have to peel an onion back in order to plug in different APIs. They're saying, we're getting rid of all that. We're going to build it out internally and be able to offer an easier platform for fintech companies to just plug into our system. And they beat out, we had put in an unsolicited offer on that. The advisor for the seller went out, did a market check, and we beat out every bank out there. And our party looked at it and said, look, we've got $80 to $100 million of capital we are planning on spending on this bank. So it's an equation. How much do we have to pay to get it, and how much will we have left to build to inject to build this out? And so the larger bank deal we do, the less we have to build out. And they kind of just figured out, hey, 160 we're good with. Whole bank M&A activity. You'll see we're up to 151 deals year to date. Last year we had just over 110 deals. From 2012 to 2019, we averaged about 250 deals a year. We're not going to hit that level this year, but you're seeing an uptick in activity. And what I expect over the next 2 to 3 years is we might see 3 to 5 years of M&A activity in that time span, because you've got NIM compression, you've got regulatory pressure, you've got taxes, you've got aging management and boards, you've got aging shareholder groups. So there's going to need to be more liquidity. You've got the fintech and tech pressure out there.
So just a little context on that. So just our firm alone, since December, has been averaging one M&A transaction every 2.5 weeks. And we've got several more that we think we'll announce over the next 4 or 5 weeks.
I just announced one on Friday in Madison, Wisconsin. I've got another one that's going to get signed this week or next week. Have another Midwest one that should be announced by the end of the month. We have one we're working on in the next couple weeks, a couple down in the Southeast that we've just gotten LOIs on. So there's a lot of activity right now. Have another 4 banks that we're getting ready to put together what we call a CIM, a CIM, Confidential Information Memorandum. So your activity levels are picking up. And when you look back at last year, too, you have to remember that about 40 deals happened in the first 2.5 months before COVID even happened. So then you look over the balance of the year, and you had just over 70 deals for about 9.5 months of the year. Back to my M&A pricing. Again, we're back up to where you see we were in 2019. Last year, we dropped down into the mid-130% of tangible book. But you'll see we're still below the 175 of tangible book that we had in 18. And the question is, what's going to drive multiples higher? If your earnings are going to be under pressure, right now we've seen that asset quality hasn't really been an issue for people. The question is, when regulatory relief, when all this stimulus ends, do you start to see some kinks in asset quality of your customers and see that tick back up? Organic growth, where are we going to see that? That's what's driving a lot of M&A deals right now, is people are saying we're not seeing organic growth in our existing markets, so we're going to look at a seller and ideally make that purchase maybe in a new market, maybe in a contiguous market, and we're able to get better growth. You saw one of the big MOEs of the year, Bancorp South and Cadence, down in Mississippi, Texas, throughout the Southeast and Southwest. Bancorp South, great bank, they used to do 4 or 5 deals a year, buying a $400 to $600 million asset bank, but by doing 4 or 5 a year, they would buy anywhere from $2 to $4 billion of assets. Then they did the Cadence deal and essentially doubled in size. And what they viewed by it is Bancorp South was in a lot of lower growth markets throughout the Southeast, not really in Florida, but Mississippi, Louisiana, Alabama, Arkansas. Cadence in Texas and Florida, they did that to get into higher growth markets where they thought they'd be able to grow at a quicker pace on a pro forma basis. It came with some credit quality concerns around Cadence, but that was their view of doing that. Whole bank M&A on a price to LTM earnings. You'll see we're hovering in the low to mid-20s up until 2019, and then we dropped down to about 19 times and then shot back up to 22.3 times, and now we're at 17.1. So it's been moving quite a bit. The tough part from an earnings perspective is in these LTM numbers, there's a lot of noise in the last 2 years. Again, you've had PPP, you've had huge provisions, you've had reversal of your provisions. You've had mortgage. I have a client we're selling, one of the ones that should be announced in the next few weeks. They're call it a $500 million bank. In 2020, they did $2.8 billion in mortgage originations, and so they made pre-tax about $26 million. That's not realistic for what they will do into perpetuity. So the question around that is when that deal, pricing won't be disclosed, but you're not going to see a 17 times earnings because banks don't value mortgage and some of those one-time items at the same earnings multiple. Premium to tangible book premium to core deposits. So this just looks at the premium above your tangible book as a percentage of your core deposits. It got up into 10% back in 2018. Deposits used to be somewhat valuable. It's trickled off. Now it's gotten back up to about 7.3%. But the big issue that Curtis touched on earlier and we're seeing is rewind, 4 years ago, you take a 50% lent up bank with cheap deposits. That was in high demand because banks would say, we'll buy that. We can redeploy their excess liquidity into our stronger growth markets. If we're higher lent up, we can also run off some of our higher cost deposits. Now you're seeing those banks struggle to find buyers because all the buyers have, for the most part, a lot of excess liquidity. And they've been able to run their deposit costs down. So they're saying, what do we do with this? We already don't know what to do with our own liquidity. Maybe there's value in that down the road, but I don't know. It's hard to put a value on it today.
But historically, deposits are the fuel that run community banking. And so it takes a little bravery and maybe a little patience on the earnings side right now to be a buyer for a bank like that. But with prices low, that might be a very strategic move to buy up some of these high liquidity banks now because deposits are going to come back in style at some point.
Yeah, we as a firm continually believe that deposits are actually a bank's best assets, even though it's on the right side of the balance sheet. When you look at low-cost core deposits, typically the one thing you have in common with those banks is the age of the bank. And as a bank, you cannot change the age of your bank. So if you are not a 100-year-old bank that's had those sticky low-cost deposits, if you're a de novo or you started 10 years ago, the pandemic was actually a blessing for a lot of those banks because they were able to run off some of that higher cost funding. But typically, low-cost deposits are in older banks. And they do ebb and flow in value, but it's difficult to change that. Again, PPP, I think, was a blessing for community banks. It essentially was a backdoor capital injection from the government that gave you as bankers the ability to go out and build relationships in your market and actually be applauded by your customers versus when trust preferreds came out and you all were the evil people in the room, you were terrible to society. Yet, if you look back, the government pumped more into banks through PPP than they did through trust preferred. But no one out there realizes that. Recent uptick in larger merger of equals. Here's just a quick look at what's happening out there. You're seeing these deals of like size coming together. And one thing to note here that we will talk about a little in the future is none of these deals since the First Citizens CIT deal have closed yet. And I'm sure you've all heard out there with the DOJ, there's going to be more regulatory scrutiny around M&A deals. So some of these bigger deals are taking longer to get closed because they're facing longer wait times and application approval process in the regulatory environment. The thing that I think is the most important on this slide to realize is that a lot of you in this room are sub $5 billion in assets. Majority are definitely sub $10 billion in assets. But where I think it's really important to focus on this, if you are thinking about being a seller at any point in the near future, is you get banks on this list that historically, like I said with Cadent or with Bancorp South, historically would buy a $400, $500, $600 million bank and just do multiple of them a year. We had a deal going off, and they said, guys, it's $350 million in assets, $400 million, and they said, we just don't know if we can do that anymore. It would have barely moved the needle before doing Cadence. Now we've done this. You look at in the Midwest, First Midwest, Old National coming together. First Midwest actually had a deal teed up. Old National said, nope, you got to cancel it because we're going to be doing this, so shut down discussions. First Midwest used to look at smaller Chicago banks. Now they're not going to really focus on that. You get a Wintrust who, they haven't done an MOE, but they've grown $10 billion. They now are saying they need to start focusing on $1 billion. Glacier, I had a conversation with them. They're not on this list, but they're a competitor to First Interstate. All these bigger banks are saying we're starting to have fear of missing out on that couple $1 billion bank in assets, that larger deal that may or may not come to fruition over the next year or two, that we might just overlook that $400, $500, $600 million bank opportunity. We may still have some interest in it, but from a priority standpoint, it's lower on the totem pole. And that's where I fear for a lot of the smaller banks is the legacy serial acquirers may not be in the mix anymore.
So that's both a threat if you're a seller, that's kind of a threat that there might not be enough buyers, especially at higher price points for all the sellers. But it's also an opportunity. If you're if you're a bank with private stock or a cash buyer, the competition for banks that you want to acquire is probably lower. And we'll see in a few moments here that the pricing has changed and that cash buyers are now actually able to be very competitive with stock buyers. So it's both a threat and an opportunity. It just depends on how you look at it.
Yes, why don't you touch on
Sure.
this slide?
So from a price to tangible book standpoint, we've got this slide broken down into the difference between stock buyers and cash buyers. Back in 2019, there was a 25 basis point difference. If you were a seller and you could attract a publicly traded buyer, you would get 20, 25, 30 basis points higher price to tangible book because you were getting that buyer's stock that was trading at a higher price. Now, on the right-hand side in blue, the banks that have sold to publicly traded buyers are at 156 of tangible book, reflecting the lower price of publicly traded stocks. Notice that cash buyers have actually paid a little bit more. So if you are a private bank, a family-owned bank, this is a great opportunity for you to take advantage of this somewhat unusual circumstance in the market where you can actually be very competitive as a buyer. If you look at the prices to deposits, it's very similar. So credit unions is another story that is really a Hovde story. I think Hovde has done either 19 or 20 of these transactions involving banks selling to credit union, and this guy right here has done most of them. Why don't you talk about that?
Yeah, so it's one that, bankers in the space are always mad when a credit union buys a bank. I agree there are definitely some unfair advantages that credit unions have. But when we've worked with banks, we advise a board and we help them get whatever they're looking to achieve, whether it be a liquid currency or cash or the highest price or the best cultural fit for their management employees and customers. So at the end of the day, the bankers are the ones making the decisions here. And in plenty of cases, what you're seeing in some of these credit union deals is that there isn't a big universe of bank buyers, or the bank buyers that would look at it are saying, I'd pay 1 to 110 of tangible book. And then the seller's sitting there saying, I don't really want to sell for that. So maybe I am better off. And we just did a deal in Madison last week, like I said. We went out, we reached out to 18 parties or so. We got 6 bids, 3 from credit unions, 3 from banks. It came down to a bank and a credit union being the final 2. And ultimately, this was an old mutual that did a conversion that they thought through the cultural side of things, A, the price ended up being better, but B, through the cultural side of things, they said, we think it'll be a better fit for our employees than partnering with another bank. I have another deal I worked on where our buyer or our seller said, we just want kind of top dollar. This is the mortgage company. And we reached out to 40 plus parties and we had less than 6 bids. So less bids than we did. Part of it was because the mortgage people just couldn't wrap their arms around it. It was a slower growth market than the Madison, Wisconsin market. And that's one where most banks passed on it. They just said, we don't understand it. We're a multi-billion-dollar bank. We only do $300 million of mortgage origination. We'd have to completely overhaul our operations, understand this if they're doing $2.8 billion. And so this is where a credit union was one of the only buyers here. So you're seeing a bigger push from credit unions to get into the space. And at the end of the day, their cash is as green as a bank's. So depending on what a board is looking for, it can be a good opportunity. Another thing to consider here is that in most cases, you see a lot of these banks that are selling to credit unions are actually subchapter S corporations because a credit union can't buy a charter. They buy the assets and assume the liabilities. And so you have a double taxation. If you're a C Corp, as the proceeds from the sale of your assets flows up to your holding company, it gets taxed before it even goes out to your shareholders and then has capital gains taxes. So a lot of the deals are where it's a flow through and you don't have that double taxation. But you'll see, starting in 2018, 9 deals, 14 in 2019, 6 in 2020, and 10 in 2021. You'll see it's been prevalent down in the Southeast and the Midwest. If you remember back to the starting slides that Curtis showed of this map, Southeast, Midwest have some of the largest numbers of banks out there. I think you're going to continue to see more of this activity in the Midwest, where you have a lot of smaller rural banks that may not have a logical bank buyer. And so an opportunity would be for the credit union to move in and gain some assets, gain a new market, new constituents. These are just some of the recent deals. We worked on this doesn't have our deal from last week because we had to get this over a week and a half ago, I think it was. So what creates value for banks?
So get that question a lot. What can we do to enhance the value of our bank? We're thinking about selling it. So let's just kind of go over what it is that drives a high price versus what limits the price, the value of a bank. The main thing is the market where the bank is located. Community banks are a reflection of their communities. And so communities that have organic growth, communities that have lending opportunities are going to drive value. And so if you're a bank that's in a rural market, if you can migrate toward a growth area, begin building more assets in that area, you'll improve your shareholder value. Buyers look for annuitizable growth. That's net interest margins, that's fee income. Mortgage income, loan sales, those kinds of things tend to be so cyclical, and they tend to be tied toward to individuals who represent a flight risk. And so why pay a big premium if really what you're buying is one individual's loyalty that you might be able to acquire without even acquiring the bank? So those are kind of the two major differentiations between the banks that sell for top dollars and those that have limited value. And again, the anomaly right now is it used to be that for banks to get top dollar, they had to sell to a publicly traded stock buyer that was trading at 175 or 2 or even over 2. In this particular market, we're actually seeing cash buyers be very competitive.
On some of the characteristics limiting value, non-organic growth. Again, if you've built your business by taking a lot of loan participations or, PPP, you did a lot of it, but it's going to bleed off. People will look at that and say that's not true growth, so we're going to discount the value of that. Markets with lower negative growth demographics. I sit on the board of a $2.2 billion holding company in Southern Illinois, and I'm sure some of you throughout the Midwest see it. We don't have much growth, if any. We're probably shrinking down in some of those markets, so we've tried to grow in Kentucky, Southeast Indiana, the St. Louis MSA. We've actually opened some branches in Phoenix. We just hired a lending team out of Salt Lake City. It's a family down there that owns control of it, and so they have a little more flexibility with the things they want to do. But again, they're moving out of market because they're saying in Southern Illinois, we don't have growth. So why would we want to continue to try and build our business down here when ultimately will a buyer find any value in that? High funding costs or non-core funding. Again, this used to be a lot bigger issue than it has. We've got plenty of clients that were running, 120% of cost of deposits pre-pandemic, and now they're down in the 40 basis points because they're able to use all that PPP money that came in. Reliance on key individuals with flight risk. This is like any company out there. If you have a lending officer that has a huge book of business, they're going to be attractive to a buyer. If your management team and your board have a lot of relationships that they've brought to the company, to the bank, or they themselves have a lot of deposits or business with the bank, a buyer's going to want to see that be retained. And so that's something to always think about with your key employees as you continue to grow, is the flight risk, as well as if we do decide to ever sell, how are we going to position it so that they sign on for this? Because a lot of times you can see key employees kill a deal or at least impact pricing.
So sub-debt, as Kirk mentioned earlier, has been kind of the tool for capital planning over the past couple of years. Over $4 billion of it was issued in 2020. Our firm has been very active with that. It's super low cost, fairly easy to place, and if you are a buyer, it can be a great strategic tool to help you buy a bank without having to actually issue more stock. So M&A trends and outlook. Deal pricing is going to follow the market for publicly traded banks. We mentioned earlier that the 10-year is kind of a predictor of bank stock prices, the correlation there. So will M&A pricing improve? How high is the 10-year going to go? Those two are connected somewhat indirectly, but I think that's a good indicator. Deal activity is certainly brisk. MOEs are finally turning into transactions. Banks of all sizes are doing MOEs, and they make a lot of sense. And the auction process is back for banks in growth markets. The auction process where you put together a confidential information memorandum and contact 10 or 12 or maybe even 20 potential buyers was really not popular for a few years, but it's come back. Because if you are a bank that is in a highly desirable demographic, there are so many buyers that want to be in that demographic, you can actually run an auction process and get 4, 5, 6 bids. And you can obviously see the competitive bidding environment is going to end up pushing the price up to levels that would just not be attainable in a different format. So, talking about different ways to sell a bank or to present a bank to the market, we got this slide to kind of show the pros and cons of one-on-one discussions where you can maximize confidentiality, but you're not certain you're getting top dollar because you don't know who you haven't spoken with who might pay a higher price. But it's also the shortest path to getting a deal done. In the middle is more of a discreet marketing process where you talk to 2 or 3 buyers, maybe as many as 4. Oftentimes, these are buyers that have expressed interest in the past, and you have kind of a limited auction format. And in that environment, you can maintain strong confidentiality, and you have a much better chance at maximizing the value because you're talking to more parties, and it slightly extends the amount of time it takes from start to close. And then on the far right-hand side is just the broad auction process that I mentioned earlier. And if for banks that are in highly desirable areas, that is becoming a choice that boards are making simply because of the value maximization that comes out of that. We've seen some prices in deals that have not been announced that would surprise you at how high they reached because of that format. In terms of a calendar, if the process were to start today in the month of October, kind of a logical closing would probably be in April of next year, just to kind of give you an idea of what that timeline looks like. Let's talk about a vision for the future. So we mentioned that there are some strong headwinds on the banking industry right now. The net interest margin compression is kind of chief among them, but there's also the loss of the mortgage income, the loss of the PPP income. And then there's also this kind of haunting fear that the Biden administration and the regulatory stuff is going to start flowing, and that may even bog down the M&A process. If you remember what it was like during the early days of the CFPB in the Obama administration, I mean, bank approvals were just, there was some uncertainty that was introduced into that became a major distraction. So let's talk about taxes for just a moment. Capital gains taxes have kind of moved from the front burner to the back burner, but we know taxes are going up. One thing we can all say is that we are in the lowest tax environment for the rest of our lifetimes, given our government's fiscal situation. And so if the capital gains tax rate were to go up, a bank that sells today for 1.6 times tangible book would need to sell for 1.77 times tangible book if it went to 28.8, which has been proposed recently. So keep in mind that everything is relative, and taxes can play a big role in that. In terms of the technological revolution of things, we've seen so many industries that all of us participate in get completely transformed by technology. They're almost unrecognizable now. All of these occurred in these industries. Banking has resisted and resisted, but the momentum is building. What does that mean for your bank? What does that mean for your board as you make strategic choices? When you look at the brands that drive generations, so the baby boomers are represented here by the bottom line. We liked brick and mortar institutions. That's kind of what our favorite brands are. But as generations come, they prefer more and more of the high-tech brands, and banking preferences are going to follow the preferences of these generations. It's just going to happen. In fact, when you look at how fintech has invaded the banking space, I mean lending, payments, asset management, and how long will it be before there's more and more fintechs that buy actual banks, and you find yourself competing against a company that's more of a fintech than it is a bank, but it actually has a bank charter. Banks are having trouble competing for talent across all sizes of banks, and we're seeing how consumers are using banks differently. If you applied for a mortgage loan recently, chances are you applied electronically for that mortgage loan, especially if you are a Gen Xer. You probably 70% chance you applied for your mortgage online. So here's some final thoughts before we have a little bit of time for questions. Strategic planning has never been more important. There is so much change on the horizon for banking. The decisions that you guys are making relative to where the industry is going, how quickly it's consolidating, are absolutely essential to the success of your organizations. And if your strategy is to grow through acquisitions, those partnerships opportunities are declining quickly. Take advantage of the opportunities while they exist. We mentioned about taxes going up inevitably, and buck the opportunity-averse stigma that most bankers have. There's opportunities out there. Be one of the risk takers that can position your bank to take advantage of it, and keep your board current. Nothing is more difficult than leading an organization, as all of you are tasked with doing, when some members of your board of directors are simply operating on old data, old pricing data, old trends that don't apply to this market. So bring in professionals to update your board on what's happening with presentations just like this one. Kirk and I love doing this for banks all around the country. There's other quality presenters at this conference that would also do a good job for your bank. Take advantage of those. Tom, thanks again for letting us be a part of the conference.
Thank you, Tom, and thank you, everyone.